leveraged loans in combination with treasuries together is kind of the peanut butter and jelly sandwich of the fixed income market, if you will. Because think about this, leveraged loans do well when rates are rising. The treasuries do well when rates are declining, right? So they help offset each other a little bit there. So if you put loans together in a portfolio with treasuries, again, you get the combination of those two things, the peanut butter and jelly sandwich, generates really good risk-adjusted returns.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting, as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunn.
Thanks for that introduction, Niels. Today, I'm delighted to be joined by David Giroux. David is an award-winning portfolio manager at T. Rowe Price. He's a 6-time nominee and 2-time winner of Morningstar's Fund Manager of the Year award. He is the portfolio manager of the Capital Appreciation Fund and the Capital Appreciation Equity ETF, and co-portfolio manager of the Capital Appreciation and Income Fund at T. Rowe Price Investment Management. He's been with the firm 26 years. He's head of investment strategy and also CIO for T. Rowe Price Investment Management. And he's also the author of Capital Allocation. So, David, it's a pleasure to have you with us. How are you?
Good. Thank you for looking forward to the discussion today.
Good stuff. Well, as I mentioned, you've been with T. Rowe Price, I think, for all your career. But how did you get interested in markets and investing in the first place?
I became a finance major my sophomore year of college, and I started reading a lot of books about investing. Actually, that's probably how I got a job at T. Rowe Price. I think I read like 40 books on investing by Ben Graham and Warren Buffett, and really just found my passion in life with regard to investing. And again, I joined T. Rowe Price in '98, and became an analyst 2 years later. Covered autos, industrials, and then in '06 I was asked to manage the cap appreciation strategy or fund at the time. And you've been doing that ever since. And as you mentioned, we've kind of launched a couple other products along the way that are similar in strategy, maybe just a little bit of slight difference in asset mix. And it's been a while. It's been an exciting 26 years.
Absolutely. It's always interesting times in markets, but we've seen some interesting shifts over those 26 years, I'm sure, which we might get onto in a while. But maybe just to set the scene a little bit, you mentioned the different strategies and funds. Some are, I think, bonds, equity, some are equity only. So maybe if you could give us a sense on the strategy and the kind of the size of the portfolio and any constraints.
Sure. The biggest strategy is the cap appreciation strategy. That strategy is about $95 billion in assets. It's a traditional balanced strategy, although the asset allocation is a little bit different. We tend to have a little bit more high quality, high yield, high quality leveraged loans. To be a little bit less treasuries, really not any mortgages on the fixed income side, and we try to run the equity sleeve a little bit less aggressive than that of the average balanced strategy. we've had a very good track record over time on that strategy, and that kind of led us to launching in 2023 an equity only strategy that a couple more names, more like a 100 name portfolio, with a goal of basically trying to outperform the market every year, a goal of having a little bit less risk and having better tax efficiency than an S&P 500 index strategy. So we've been running that strategy is a little bit more than $4 billion in AUM now. And then we launched a capital appreciation income in partnership with our quant team in Farashugi. And that strategy is a couple $100 million in size, but it's kind of the inverse, a little more of a conservatively run balanced strategy. That's a strategy with more like 40% equities, 55% fixed income, and currently about 5% in cash, but a little bit more conservative relative to CAF, the mothership, if you will. But in all, a little bit around $100 billion in assets. Three main strategies.
Good stuff. And obviously within the larger capital appreciation strategy, you have the facility to be quite dynamic and responsive to market changes. So, in terms of that equity allocation, how high or low could that get over time?
Yeah, it's a great point. I think what we typically are doing something that very, very different than most managers. During COVID, we put $9 billion to work when we were only about $50 billion strategy. We went from 50% cash to 2% cash. We went from 55% equities to 72% equities, basically in a month. We in 2009, 2011, 2015, 16, 2018, 2020, 2022. When risk assets are cheap, we will buy those risk assets aggressively, whether that be equities, whether it be high yield, these leveraged loans. We're zagging when the market's zigging, if you will. We are adding to risk assets when risk assets are cheap, and we're pulling back from risk assets when risk assets are expensive.
Okay. And I read somewhere that a quote, I think, was attributed to you, that you were probably as negative about the S&P 500 as you've been in a long time. Without putting words in your mouth, is that correct?
Yeah, I think that was a comment we made. I think it was a comment from the Barron's Roundtable discussion earlier this year, and it's simply a function of 2 years of 20% market returns at a time where S&P 500 earnings have not been nearly 20% a year at all. I think earnings this year will end up, earnings in 2024 grew more like 10%, and earnings was less than 10% in the year prior. So we just have a lot of multiple expansion, a lot of high expectations in the marketplace, and I think regardless, wherever you look, there's not really great value, unfortunately. Cyclicals were pricing in a pretty big recovery. The AI trade was, in full throttle, if you will, very, very, maybe a little bit extended, if you will. And then you had some kind of nifty 50 stocks, the Costco's of the world that used to do for 35 times, 57 times earnings. Walmart used to have 25 times earnings, that rate for 37 times earnings. And so there was very, very few pockets of opportunity in the marketplace. So not only was the market expensive at 22 times forward, but if you go, cyclicals, retail names, these nifty 50 stocks, AI, it's just, there wasn't much area of good value in the marketplace outside of maybe healthcare and some idiosyncratic names. It was just probably as, usually sometimes when you have a situation where one area is really, really in favor, other things are really, really cheap. This time, almost all parts of the market were kind of a rising tide, driving all stocks higher.
Yeah, interesting. I mean, I was surprised to hear that. I heard you mention that on another podcast, and I was kind of surprised because I think the perception among some investors is, for sure, the high tech, high growth stocks are being richly valued, but maybe that the rest of the market wasn't that expensive. But certainly by the measures you look at, you're saying that most of the sectors are valued highly relative to their typical averages. Is that right?
Yeah, I think that's true. Yeah, I think, and that's maybe it's a little bit different if we had a conversation in 2023, or obviously 2022, where cyclicals were really, really cheap in 2022. If you take a step back, I think just think about financials. If I think about banks historically trade in a range of, let's call it 8 to 12 times earnings. And a lot of banks today, that range has kind of moved from 8 to 12 times earnings to kind of 12 to 16 times earnings, right? And, Goldman Sachs, it wasn't too long ago, we bought Goldman Sachs a little above tangible book value. And now I know there was an expectation that could they ever get to 1.5 times tangible book value. And now they trade for 2 times tangible book value, right? So that usually doesn't last very long. So you have, financials, trading at very, very high valuations. Industrials, until recently, view that they'd have a big economic recovery. They were trading for 23, 24, 25, 26 times earnings, well above historical averages. You also had, again, there's, I always call it like the nifty 20, where there was just some kind of companies that were, their algorithm, their growth rate really hasn't changed dramatically, but the multiple the market was willing to pay for them expanded dramatically. Costco was probably the poster child for that company that used to trade in a range of 28 to 35 times earnings. All of a sudden went to 57 times earnings, right? Walmart, best case scenario, Walmart has a 8% EPS growth rate with almost a 2% dividend yield, 10% algorithm. Again, used to trade for what's called a range of the low 20s to mid 20s. All of a sudden went to 37 times earnings. You had a lot of names in that camp of good companies that used to trade in a range, and the market just all of a sudden awarded a much, much higher range than they have historically for those companies.
Yeah.
So when we think about that, outside of healthcare, which had some issues, we did not see really good value anywhere in the marketplace. Even utilities, which has been a favorite for ours for a long period of time, has had a really big upswing because of AI and more data center needs, power consumption going from 0 to maybe 2 or 3% a year. That's going to step function change for those kinds. But again, they've been good stocks as well. So, the areas where we see opportunity in the marketplace really, really narrow versus history.
And what would you say has driven that step change in valuation? Is that a function of the momentum trade or just generally bullish sentiment or a bit of both?
I think it's a combination of multiple things. I think there's in some cases, a stock that just works over a period of time, especially in an area where other stocks aren't working. It just becomes, success breeds success, and the multiple goes higher and higher. And yet, again, that historically speaking, one of the ways you can avoid underperforming is avoid companies that have high multiples, right? High multiples versus history. So I think you've kind of got to the extreme in the Costcos of the world, the Walmarts of the world, the Cintas of the world, where again, low double-digit algorithms that in some cases now trade for 40, 50, 60 times earnings. Doesn't make a lot of sense from a long-term investor's perspective. Some of it is just there's a lot of positive sentiment around what Trump was going to do from a policy perspective. I think in many respects, what we've seen that those policy changes are probably more detrimental than positive. So that's probably as we've seen this morning and last night, and bigger and bigger tariffs and retaliation and higher inflation. That's not a good thing. A lot of disruption into scientific community with some NIH cuts. Just probably more disruption than positivity on the Trump side. So combination of a lot of factors, momentum, sentiment around Trump, but all those things kind of drove that market valuation higher. What's interesting is if you look at where S&P 500 earnings expectations were in March of last year, the market thought 2025 earnings would be like 279. And in reality, I think once earnings settle for this year, the expectation for 2025 is down to like 269, 268. So again, it's funny, we had this big market rebound, even though earnings expectations of 25 have actually come down a little bit.
Interesting. So obviously, you're referencing various macro factors there around Trump, et cetera, and the outlook for the economy. But at the same time, you're placing a lot of weight on valuations. And, a lot of people will say, well, valuations, that's fine, but they don't determine stock prices over the next 1 year. So how do you blend that kind of valuation centered approach with being cognizant of the macro developments and then taking it all together to determine how much risk to allocate in the market at any point in time?
Okay. Well, what I would tell you is if you just take a step back, let's just take a step back for a second. If you think about, if you think about the market returns, let's call it 10% over time, 10% of the time when there's kind of blood in the streets, when markets are cheap, when sentiment is bad, in that period of time, the risk of loss in a 12-month period of time goes much lower and expected returns are much higher. So obviously we're not in that period of time right now, right? Valuations aren't cheap, markets aren't down a lot. So just by that very factor, if you agree with that sentiment, you would say the long-term returns 10, we're not in that situation. So if you X out those really good periods of time, more like you say, like we're like at 9% kind of returns. But I think, valuation by itself, to your point, is not that not that meaningful. And there has been a big shift in the marketplace over the last 20 years. In 2006, financials, materials, energy was 45% of the S&P 500. And those are low multiple sectors. Those are 10 multiple sectors, right? Today, those sectors now only represent, let's call it 25% of the S&P 500 earnings, down from 45%. And what's a lot bigger? Semiconductor, software, areas that trade for higher multiples, generally speaking. So there is a mixed impact that drives the valuations of the market higher. And you can't look at the market today versus 06. I completely agree with that mixed impact that's driven multiples higher. But even if you segment the market like we do, what you would find is what I call traditional growth stocks. Let's call it 44% of the market. They historically trade for about 29 times earnings. They're at 32 times earnings today. If you look at heavy cyclicals, insurance companies, financials, banks, some industrials, machinery, these are companies that normally trade about 12 times earnings on average, trading at 17 times earnings, well above where they would normally trade. And then again, we talk about some of these nifty 50 stocks that collectively would have traded in a, let's call it mid to high 20s bucket, now trading collectively at 40 times earnings. So the valuation is not just a little bit elevated in some of those areas, it's really elevated. And so I think when you have a combination of extended valuation with maybe overly rosy fundamental outlook, which doesn't appear to be the case, right? That's not a good environment. That's not a good combination, if you will. And again, what I would tell your listeners is when we look at we are longer term investors. I have no idea what's going to happen today, tomorrow, next week. It's not what we're good at, honestly. But what I can tell you is we model every company in the market through the next 5 years. And I can tell you that if you look at a reasonable assumption for earnings power in 2030, maybe a little bit more than $400 of S&P 500 earnings, and you put a normalized multiple on that, which reflects the mix of the market, you can make an argument that the market in 5 years in the future should be, 7,200, 7,100. And that kind of spits out a low fives kind of total return from where we are today. And again, that's just not that attractive. Now, when I did that same analysis in 2022, that was spitting out next 5 years, it was kind of spitting out a 12, 13% kind of return. But that was when there was sentiment was not great, valuations were cheap, and a lot's changed, right? We're in the opposite position where, fundamentals maybe are plateauing a little bit at the same time where rates are staying high and valuations are extended. Just not a great setup.
No, I take it. Yeah. I mean, if I was to take the other side of it and maybe kind of reflect some of the more bullish sentiments you hear, it might be along the lines of, okay, I hear what you're saying about Trump, but regardless of Trump, we're in the midst of a productivity boom, the digital revolution, which is going to underpin productivity growth more generally and growth in earnings. Yes, multiples are high, but they might stay high over that 5-year period. And we're into kind of a higher nominal GDP type environment than we were maybe in the last decade. So all of that together might underpin higher returns for equities. I mean, what would you say to those types of arguments?
What I would say is what we do really well. We are individual micro-analysis, and we're doing 500 micro-analyses to come up with that. I know, I get 99% of what I do is kind of the micro company analysis, and that kind of, if you do that at 500 company levels, you can kind of build a bottoms-up analysis. What I would say is, again, I think we are believers that AI is clearly a positive. But again, I think, when you have companies like Palantir that trade for at one point were trading for 90 times sales, the expectations are so high. I mean, what do you have to believe a Palantir is a good stock? From its highs, you have to believe that they're going to compound revenue at a 25 to 30% rate for the next 10 years, that their terminal multiples is 40, terminal margins are 40, and you're going to get a 30 multiple on that. It's just, the odds of that are very, very low. And even if that were to happen, you're going to get a very, very low return over that period of time. So what I would say is, there probably will be some more productivity from AI. But I also would say, remember, the difference between the last decade too is 10-year average, probably 2.5% the last decade, right? I don't think we're going to average 2.5% on the 10-year the next decade. The decade prior to COVID was a decade where the Fed was doing everything in its power to get inflation to 2% and was struggling, right? They were quantitative easing here and there, keeping rates low, and they still struggled to keep that. So so could earnings growth be a little bit stronger than the last decade? Absolutely. But I think rates are also a little bit higher, right? And again, even though the market mix is more positive in the last decade, I don't think the market mix supports a 22 multiple.
Yeah. So, and effectively, what yield are you assuming, or is there one yield for the 10-year over the next 5 years that built into your model?
We assume about a 4% 10-year is the right.
Yeah.
I think it's right around there. I think it's either 3.95 or 4.05.
So, by the same token, if yields prove to be higher, there would be downside risk to your forecast on that basis as well. Is that right?
There would be, although I will say, it's a funny dynamic. If you look at since the Great Financial Crisis, the correlation between interest rates and the S&P 500 multiple is zero.
Okay,
I mean, it's literally zero. There's basically no correlation. Now, again, part of that's what we talked about before. The market mix.
Yeah,
rates have gone up, but the market mix has gone up too. If the market had been constant, there'd be a higher relationship. Just like there was a very, very high relationship from 1966 to 1998. There was a very high correlation between interest rates and the 10-year and the earnings yield of the market. Again, last 27 years, that's kind of gone away though.
And I mean, I was curious about that point. Obviously, that is one of the changes that we've seen over time since COVID, basically, that the bond equity correlation has shifted. As you say, historically, bonds and equities were positively correlated and then became negatively correlated. And then as we went, 2022, we were positively correlated again. Is that something that is a key input into your, portfolio construction when you're looking at the mix between equities and fixed income or not?
I would say, and again, it's funny, we've actually seen it here in the last week or so as the market's coming to pressure. I think if you look, 22, I feel like is a little bit of an aberration. If you look at the last 30 years of history, it's very, very rare to have an environment where in a period of time where equities are coming down, where treasuries do not appreciate in value, right? I think 22 was we went from, sub 2% interest rates, or inflation to 8%. And that was, and the idea is how long it was going to take us to get back to kind of normal. And it's probably taking us longer than everybody thought to get back to normal. And so I think that was hopefully that was a one-time event that we won't have repeat. That was a culmination of a lot of things kind of drove inflation to 8%. That was policy decisions in the Biden administration. That was policy decisions of the Federal Reserve. That was a supply chain challenge. That was a pandemic. All those things kind of happened all at the same time that kind of drove us that place. So I would just say most of the things that would cause a market meltdown, a market to fall 5, 10, 15, 20% would probably be accompanied by a decline in interest rates. Most of those things, not all, but most of those things.
You did talk about the inflation going to 8%, and we mightn't see it going up that high again, but there is kind of that view in the market that inflation might be a bit stickier, that we might see more of these kind of mini flashes of higher inflation. I mean, given that you're focused on financials, equities and bonds, what levers do you have to pull if you really were strongly convicted that inflation was going to be higher? Would that push you to certain sectors, or would you just have to live with that possible scenario of bonds and equities falling at the same time?
Well, again, we have a lot of flexibility in the strategy, right? So one of the things that we own, about 10% of the portfolio is in leveraged loans. Leveraged loans are a great product, right? They're floating rate in nature. If rates stay higher for longer, you get higher yields. So, if you think about it in a portfolio construct, having that high quality leveraged loans be 10% of the portfolio, that's an asset class that had positive returns in 2022 when rates were rising. So that helped buffer some of the negative returns in equities, help buffer some of the negative returns in treasuries. Actually, at the time, we didn't really own much treasuries at all. So I think having leveraged loans in the portfolio is an option. Again, we've actually brought that down a little bit as the rates on treasuries have risen, the yields on high yield have risen. We've raised that exposure. What I would say is we are constantly making decisions on where is the best risk reward in the marketplace, right? So if I go back to 2022, even though rates were, rising and inflation was higher, the yields on the return we could get in investing in equities was off the charts. Like I said, 12% for the market, which is great. And we can obviously do better than the market. And you were getting kind of, let's call it 4% treasuries and 6% in loans and high yield. Owning a lot of equities made a lot of sense. Now, if I think about that analysis today, getting a little bit more than 4% on treasuries, 6% on loans, 6% on high yield. But again, I just talked about the equity returns over the next 5 years. We would project, maybe conservatively, but about 5.2%. So you're getting higher returns in fixed income today than on a forward projection basis than you're likely to get in equities. And so that we are constantly looking at that analysis. Is it better to own a utility that has half the beta of the market, or buy a single B bond that has a beta of 25% of the market? Right? We're constantly doing that kind of that analysis. There's no silos. We manage the fixed income portion of CAF and CAFI together with the EFI combination. So we're constantly looking at those decisions all the time.
Yeah. And at the moment, what's the thinking on that? Like, obviously, as you say, you get 4.25%, whatever it is in treasuries. Now, obviously, you pick up a couple of percent if you go into levered loans. But if you get a severe downturn, presumably they are the sector that are going to get marked down and face stress. So your treasuries, you'll get your duration there. So how much is it driven by, I suppose, the total return expectation, and how much is it driven by their potential characteristics in an adverse scenario?
It's both. It's actually both. We do a multi scenario model around that with probabilities of downturns, all that kind of stuff. And what I would tell you is, again, treasury look really good there. But I think one of the things just to keep in mind is, because we don't know exactly what the future is going to hold, right? So leveraged loans in combination with treasuries together is kind of the peanut butter and jelly sandwich of the fixed income market, if you will. Because think about this. Leveraged loans do well when rates are rising. The treasuries do well when rates are declining, right? So they help offset each other a little bit there. If you had an environment, to your point, you had a big downturn, the rates might come in, which is negative for loans, and spreads might widen, which is negative for loans, but treasuries actually rally. So if you put loans together in a portfolio with treasuries, again, you get the combination of those two things, the peanut butter and jelly sandwich, really generates really good risk-adjusted returns, right? That helped in 2022. So far year to date, treasuries outperforming loans, but the combination of those two really produces really good risk-adjusted returns. So we try to have those exposures in most environments somewhat similar in size. And again, what we own in loans, we own things that are very, very safe, the highest quality loans. We're not speculating in dish. We're investing in really high quality companies that have very, very little limited cyclicality that tend to not declining from a spread basis very much, even in their downturn.
So obviously you've been running the strategy since 2006, and you've been in the markets, 26 years, which spans a long time. There's a good chunk of history. I mean, how much does that, do you go back and look at periods in the past or not? I mean, people draw parallels between now and the late 90s. Obviously, we're talking about how the portfolio might perform in a severe downturn. I mean, obviously, I guess you might stress it on the data during the financial crisis. Are they all inputs into the decision making?
They are. Again, the future is very difficult to discern. Every cycle is a little bit different than every other cycle. And again, what I would say is, we understand, we studied every market downturn, for basically the last 50 years. We thought about, how far do markets decline. We have factors we look at, which I can't really go to the proprietary, that would tell us when is the time to get really aggressive with the portfolio. When is the time to go from 57% equity exposure today to 72? We know that point. We know what point does the market return get to double digits. We know all those points. We have a predetermined plan put in place that if the market went to X, we would go most likely from 57% equities to 62% equities. If the market went to X minus 15%, we know we would probably go from 57% equities to 72% equities, right? But everybody else who's really bullish today, capitulates at the bottom. We're going to be all in on equities in that environment, right? And we will probably be selling treasuries all on the way during that period of time and buying high yield or buying leveraged loans, just like we did in other downturns. So we know how spreads go down, how spreads expand in downturns. We know how we looked at how 5-year, 10-year, 3-year treasuries change. We have a wall of data, that helps us make intelligent investment decisions, irrespective of the emotions that most market participants might be going through in a downturn.
Okay, good stuff. And just for to be clear, are you at 57% equities now? Is that right?
Yeah, just to be clear, we do sell calls on portions of our equity, so we look at it like a delta neutral basis.
Okay,
but so if you X out the call, if you include the calls, our net equity exposure is about 57% today,
and that's very much on the low side of the range in the track record of history.
We've averaged about 61 to 62. So, we're probably about 500 basis points underweight that exposure. And again, we would be underexposed to the Palantirs, the Teslas, the Broadcoms of the world, some of the companies that maybe a little bit, the Costcos, the Walmarts, some of the more speculative or highly valued stocks in the marketplace too.
Yeah. So maybe tell us a bit about the process for stock selection. Presumably, as you say, you do it bottom up on all the stocks. So it presumably is heavily valuation driven. I have heard you elsewhere speaking a lot about the importance of management and great management. So, I guess it's a mixture of qualitative and quantitative, but in your own words, how do you balance those factors and what does great management look like?
Sure. Great questions. Great credit. So when we think about the market, we look at the 500 companies in the market and where are we going to spend most of our time? So we've done a lot of, whether it be qualitative or quantitative studies on this. What we've basically found is there's 6 reasons companies tend to underperform the market over a 5-year period of time. 6 main reasons. We try to avoid those types. We call it the fatal flaws. Bad management team, poor capital allocation, secular challenge, a company that doesn't have a business model that supports high single-digit EPS plus dividend yields, or a company that can do that, but it's very, very high risk, and then an extreme valuation. Again, we mentioned a couple companies today that have what I call an extreme valuation. So if you go through company by company in the marketplace and you say, I want to avoid all these companies that have one of these 6 fatal flaws, it kind of leads you to a stock portfolio of a universe of investable ideas, so 115 stocks at the low end to maybe 140 stocks at the high end. Then I think today it's like 122 stocks are kind of investable for us today. And we're going to spend all of my time focused on those 122 stocks. And for cash equity sleeve, we're going to select maybe the 60 best of those names. And for the CAF ETF, we're going to select the 90 best names of those. Now, to your question about what makes a good management team, it's the right incentives. What are they trying? What is the management team trying to do? Are they trying to build a big empire? How good are they operationally? Right? How often do they come back with excuses about why they can't hit their algorithm, why they can't deliver on what they've promised? Right? Do they surround themselves with really good people, or do they surround themselves with weak people who don't want to challenge them, right? A good management team deploys capital wisely, whether it be buying back stock, doing bolt-on acquisitions at high returns, or are they more strategic? In my term, means poor returns on capital for their deals. So it's all those things that are really important to our process. Like, one of the names I mentioned before, we have mentioned, but I mentioned in the past, is just kind of like, GE was a company that we didn't focus any time on because we knew they had a horrible management team, had horrible capital allocation. Jeff Immelt's probably destroyed more shareholder value than any other CEO in the history of mankind as a CEO. It's kind of crazy. And again, it wasn't our focus, but the day Larry Culp was announced as CEO at GE back in 2018, I literally didn't do anything else for 14 days but do a deep, deep dive on GE. And as a result of that, it's like, there's a lot of upside here. We have a change agent. Capital allocation is going to be better. Company's not going to go bankrupt. And we made a giant bet that worked out really well for us, right? But that's an example of, company with a lot of fatal flaws, going to a company that didn't have any fatal flaws. I mean, clearly had challenges at the time, but we had a high degree of confidence that the management team could and capital allocation would get a lot better, and we made a big bet. But that's, we want to invest with management teams that we trust them. We have a long-term perspective. Capital allocation is good. That's really important to us.
Okay. You mentioned capital allocation a lot, and obviously you've written a book on the topic. I mean, we have seen, I suppose, I don't know if it feels like a growing feature of the markets in the last 10 years of share buybacks, and that's been an important driver. I mean, from your perspective, do you see that as good capital allocation? Obviously, I guess it depends on the stock-by-stock basis, but generally, are you favorable on that?
It really depends. It really depends. I mean, it's funny. Some companies the companies that should not be doing capital allocation, who should not be doing share purchase, are companies such as companies that are secularly challenged, right? If your business is in secular decline, your growth rate's slowing, your margins are under pressure, your multiples under pressure, you really shouldn't be buying back your stock because you're not getting good returns. A steady Eddie company that trades for 15 to 16 times earnings, that is growing mid-single digits with high single digit kind of EBIT growth, they should be buying stock all day long, right? Again, Costco should not be buying stock. Walmart should not be buying stock. Those are low returns. And industrial that trades for 25 or 26 times earnings should be doing bolt-on acquisitions at 12 times EBITDA, shouldn't be buying back their stock at 25 times earnings, right? So, I would actually argue in the last 10 years, as valuations in the market have risen in general, you see a lot of companies that are either in secularly challenged mode or have very, very cyclical businesses that are buying back a lot of stock, and that's not a recipe for value creation. It's really firm dependent. Like where you should go, where is the best risk-adjusted returns for me to deploy capital, right? When valuations for acquisitions are low, you should be doing acquisitions. When valuations for acquisitions are expensive, you should be doing buy share, or even building cash on the balance sheet. It's really firm specific more than anything else.
Good. And I mean, for the average investor, what would your advice be or suggestion be in terms of how to think about valuations and capital allocation, management quality, etc.? Obviously, most individual investors don't have a team like yourselves, maybe don't have the insight about the quality of the management. And then you read so much about valuations, different metrics, K, PE, everybody has... you do a bottom-up IRR of the market. So it's like, break it down into simplicity. Well, if you were if you were teaching a group of undergrads or some novice investors how to think about valuation, what are the key things you have to watch?
It's a really good question. I'm going to give you a really not great answer. I mean, the reality is, it's really hard for an individual investor to do the kind of work that we do. We have the access to management teams. We build models, at 5-6 years on everything that we invest in. I mean, it's really hard to do that in many respects. I mean, I guess the best answer would be just to buy the cap appreciation fund or the cap.
Obviously, yes.
Yeah, that we do that for you, right? We can balance risk reward within asset classes and go where the value is, right? What I would just say though, and then again, that's not going to be a great answer, but part of our strategy, Alan, is trying to find the best risk-adjusted algorithm in the marketplace for the lowest multiple, right? Costco has a low double-digit algorithm, their earnings plus their dividends, low double, maybe 10, 11%, right? That's what their historically is, all right? And they trade for 57 times earnings, right? Other companies in the marketplace, Becton Dickinson has the same algorithm, same risk profile, and they trade for 15 times earnings, right? So I would argue over time, if you have the same risk profile and the same earnings growth and the same kind of dividend, over time, those two things can converge. The multiple the market awards Becton Dickinson should increase, which increases your total return, right, over a period of time. And the multiple the market should pay for Costco should decline over time. And I think over time, if you think about a lot of the value creation that we've produced, we've created out of in CAF over time, it's finding that company and having, that the market doesn't appreciate, buying Thermo when it's trading for 11 times earnings, buying Danner at 14 times earnings, buying Fiserv at 12 times earnings, buying autos are a low double-digit multiple, and having these great algorithms, these great companies, and all of a sudden the market figures it out, and having, so you get the combination of really good earnings growth and a lot of multiple expansion as well at the same time. And that is what kind of produces, that's how you produce low double-digit algorithms can kind of go to high teens total return. That's been a really important part of our strategy. So ignore what's exciting in the marketplace and just try to find companies that you think can generate high single-digit returns, low double-digit returns, where their multiple is just too low for that relative to other companies in the marketplace. I think it's hard to do for an individual investor, but that's a lot of what we do at a very, very basic level.
Yeah. And I mean, would you regard yourself as traditional value investors? And I guess the reason I ask is we had Aswat Damodar on previously. He seemed quite downbeat about prospects for traditional value investing. His point was, the kind of screens, Graham Dodd, Buffett type screens, anybody can do it now. You can download a spreadsheet to do it for you. So you're not going to get rewarded for that type of analysis. But it sounds like you believe that is the case. And I suppose the second question is, there's a view that you can identify the cheap value stocks, but they could stay undervalued for a lot longer in the current market than they might have in the past.
Yeah, let me make a couple of points. One, the challenge with the value index is, you think about, this is going to be a very simplistic way to think about it, but 40% of a Russell 1000 index has some degree of secular challenge. The business is under pressure. It's long term. There's no mean reversion characteristics to those businesses. And if you put $40 in those stocks, the odds of underperforming are pretty high, right? Now the other 60% of the market in value stocks, JP Morgan, Bank of America, they're not the Nvidias of the world, but they're not horrible companies. And there's cyclicality. Again, if you can buy them when they trade for 9 times earnings and sell them when they trade for 12 times earnings, you can make a lot of money doing that. But the value universe of stocks will not grow earnings at the same rate as the rest of the market. We think about multiples a little. We talk about multiples a lot today in this discussion. The reason why growth stocks have kind of destroyed value stocks for the last 15 years, it's not really multiples. It's just they've grown so much faster. They've grown to be much larger companies relative to the value universe, which has been left behind. And so, but going back to your first question with regard to kind of what kind of investor we are, I don't consider myself a traditional value investor. I consider myself a GARP investor, growth at a reasonable price investing. And I would tell you, I think that is the most attractive part of the marketplace. When we look at the GARPy stock, our proprietary GARP universe, over the last, since 2006, has outperformed the market by 400 basis points per year. Earnings growth has been about 40% higher than the market over that period of time. Lower, and in downturns, earnings don't go down for those companies for the most part. They're not that cyclical. And so a lot of the alpha we've generated in the equity sleeve of CAF over time has really been a function of this 2,000, 3,000 basis point overweight to these GARPy stocks. And I would tell you that's the most inefficient part of the market. That's the part of the market. So why is that inefficient? Think about the growth investor. A growth investor with these GARP stocks say, well, I only want to make companies that are growing organically 10% a year. And so I'm not going to own these stocks, or I'm going to own too little of these stocks. A value manager might say, hey, I can buy banks at 9, 10, 11 times earnings. Maybe not today, but normally 9 to 11 times earnings. I can't pay 18 times for this GARP stock, right? A retail investor probably hasn't heard of Revity or Marsh McLennan or these companies. And a hedge fund, he wants high volatility. He wants to be able to make a call in a quarter that stocks can go up 8% or down 8% in a quarter. These are not the stocks to do that. So there's no natural buyer for these stocks, which actually sounds bad, but in many respects, what it is you have these companies that have these really great algorithms, that can generate low double-digit returns between the earnings growth and the dividend with very low volatility, and they trade for too low valuations relative to where they should be. And as a result of that, you're able to, in most cases, a lot of these things, they become a little bit better over time. Their multiples expand. And even if they don't expand, you still grow earnings 30 or 40% faster than the market over time. It's just a supply-demand imbalance for these GARP stocks, which creates just great returns for our shareholders over time.
Interesting. Well, I mean, what you're talking about there maybe reflects some of the market microstructure, and curious to get your thoughts on how that has changed over time. So obviously we've had factors like the growth of indexing, the rise of ETFs, so things like sector ETFs, easy to invest in sectors, etc., and obviously growth of hedge fund strategies, more alternative risk premia, factor bets, etc. So putting it all together, it sounds like that has thrown up opportunities to your mind, particularly in GARP stocks. But I mean, in general, has all of those changes made it easier or more difficult for you in your job?
It's funny. I'm at a traditional asset manager that is under pressure, as all traditional asset managers, because of the rise of ETFs and other passive forms of investing. Now, so that as an investor, to your price, that's been a challenge. But at the same time, as an investor, it's actually a really positive. It's really great. If you think about when I joined in 1998, there was a lot of investors who were very, very, it's a large part of the market who were thinking more than 1 year out, right? We were thinking, there's a lot of people who were thinking, oh, what's the earnings power 3 years out? What's the earnings power 5 years out? Today, a lot of those investors have just gone away. They've lost a lot of assets. You look at the kind of questions you get asked at conferences. It's so short-term in nature. And what's interesting is I think what's happened is all of the intellectual firepower investment in the industry, whether it be hedge funds or whether it be short-term investors or passive, everybody's focused on the really short term. They're trying to solve what's the stock going to do next week, next month, what's the next quarter going to be? And no one's asking the longer term question about what's the earnings power 3, 4, 5 years down the road. So I would actually argue that in the short term, the market's become much more efficient. Your ability to have an edge in the short term with data points or insights is really, really limited today. I think that will even become more true with AI, all that kind of stuff. But the kind of investing we do, the 3 to 5 year investing that we do, that focus, our North Star is that 5-year internal rate of return, that's become far less efficient. And again, you see all these very, very strange correlations today with ETFs. I give one example. It's actually it's a little bit old, but when Hillary Clinton was running for president in 2016, she tweeted, I guess it was a tweet back then, she tweeted about how high drug prices were. And it drove down everybody in what was the DRG, the pharmaceutical index. And every stock was down like 10% from the highs, right? And, a company called Zoetis, which makes drugs not for humans, but for horses and pigs and cows and chickens and goats, it was down 10% as well, or 9% as well. Now, I'm pretty sure she was not concerned at the time about the price of drugs for cows and chickens and goats and sheep and all that kind of stuff. But it was an index, and people just shorted the index, and it drove that down. Another example, when Donald Trump was elected for the first time, REITs used to be part of the financials index, and rates were rising dramatically. And so that drove, right after he got elected, and that drove financials up, but it also drove REITs up, which should have gone down because REITs were a part of the index. So people were just buying the index, and it drove. So we find all kinds of situations where people are making a tactical decision based on a sector or a thesis, and it drags something too high on the upside or too high on the downside for no real reason. And we can take advantage of that. So we like passive as investors, probably not as shareholders necessarily, but we do like it as investors. It makes the market more inefficient. It makes it far more inefficient on the long end of the curve, where we long into what we do. So we're really excited about passive. We're really excited about the market becoming much more short term because it just creates more alpha for what we do.
I mean, the growth of passive has been relentless. I mean, at what % of the market being passive does it become problematic? As you say, it's thrown up more opportunities for you, but is that something, does it become unstable at some point because of too much passive flows?
You need someone in the marketplace to act as a
liquidity provider or whatever.
Liquidity provider, but also like where, if the market was 100% passive, everybody would just be buying all the time or selling all the same time and all the same stocks, right? See someone who's trying to, discern where value is or where not value is. We do that, whether it be short term with hedge funds or longer term with us, right? So you do need some. I don't know what that's a good question. I don't know what the answer to that is, but I can tell you every 1% the market is more passive, our opportunity to add alpha gets better. And so I hope we will never see that date. Yes, that wouldn't be good if passive was 99% of the market someday in the future. Wouldn't be good for a lot of people. But again, as investors, it's a really good thing for us.
You touched on earlier, the change in the composition of the index, say, versus 2006. I think it was 45% in financials, energy, and staples back then. And obviously much more towards technology these days. Is that just a cyclical phenomenon, or is that, a structural change that we should expect it to see sustained over time? And what are the implications of that? I mean, in terms of the cyclicality of the market, if anything.
Well, it's interesting. You think about that 45%. It was energy. It was financials and materials. Those are also, that 45% is also lower margin, but it's also more cyclical, right? So I would make an argument the market has become less cyclical over time as the most cyclical components of it. If you basically take out energy, materials, and financials, the market, even in the great financial crisis, peak to trough was down less than 10% of earnings. And even if you go back to the COVID downturn, which is a short downturn, but downturn, ex those three sectors, the market was down like 7% earnings growth. So the rest of the market tends to be less cyclical than those sectors. So as those become a smaller part of the mix, the market becomes less cyclical, at least from an earnings perspective, than it has been historically. Again, the earnings fell dramatically. I think it may have been 40, 50% in the last downturn. We went from an expectation that we're going to do 95 to like $60. That was the S&P 500 earnings. So it fell dramatically in the last downturn. So what I would tell you is, the market has become less cyclical, and I think this will continue. I would think, at least from an earnings perspective. I mean, the big constituents, Apple, Microsoft. There's probably more debate around NVIDIA, more debate around what Tesla would be in terms of earnings. But I think a lot of those big companies will continue to grow earnings at a healthy pace over the next 5 or 10 years. And the challenge is, whether it be energy, energy doesn't really grow earnings very fast, right? They pay a little bit of a dividend. Production growth is very, very low. Buyback a little bit. It just doesn't grow very fast. Staples have seen a lot of secular challenges, don't grow very fast. REITs don't grow very fast. So, and a lot of the companies that are under secular challenge, whether it be a Comcast or a Charter, don't grow very fast. So I think over time, and we model out to the end of the decade, the top 100 companies in the marketplace will go from, I think our math is from 60% of earnings today to 68% of earnings in 2030 is the way we're looking at it.
Yeah. But so is the point then that, okay, you can't necessarily compare the S&P multiple today versus 2006, but even allowing for that, it's high versus its recent best. Yeah. Okay.
Once you do the segmentation, and again, I would just also say the one thing, and I don't want to get too far on a tangent here, but what I would say is you also can't compare the U.S. market to like the German stock market,
sure.
Right? Yeah. It's so different. It's autos are a tiny fraction, that's ex-Tesla bar mark, but they're a giant part of the German DAX, right? Or chemical companies are a very small part of our money. They're a large part of the DAX, right? Financials are a big part of the FTSE 100 or the FTSE index in Europe. So it's just, you can't compare apples to oranges. Apples to oranges because the companies are so different. Growth rates are so different among the US versus Europe or Japan or Australia.
Does it even make sense to have these geographically focused and, funds, ETFs? I mean,
No.
The analysis. Yeah, okay, because the analysis will be like that. Oh, the German economy is doing terrible. Oh, get out of German stocks. But hey, look at the DAX; it's the top performer this year. So why is that? It seems like that it doesn't. Global sector would make much more sense. Yeah,
I completely agree. I would completely agree. I think it's funny what we found over time is actually having international stocks in a portfolio. Not only does it reduce returns, it actually increases risk. It's because what happens when in an economic downturn, the dollar strengthens. So this supposed, and again, almost all these companies have a giant portion of the revenue outside the U.S., whether it be or outside of Germany if you're a German company. So this whole aspect of like you get a whole bunch of diversification benefits from owning a UK company or owning a UK index or a German index. It really is just a big folly, if you will. People really shouldn't. You shouldn't think about diversification from that perspective.
Okay. We touched on a little bit on NVIDIA AI, but I'm curious to get your thoughts on how AI is impacting the investing world. Obviously, it's impacting stock valuations, but in your role, are you using it? Are your analysts using it or not in terms of the stock analysis and valuation, etc.?
Not really. What I would tell you is, again, AI may help out with trying to help, with very, very short-term data points, right? It's easier to amalgamate data off of websites or web scraping, all that kind of stuff. I mean, there are things we're doing with AI that help try to make us more productive, right? I still listen to every transcript of every company that we invest in, or every company we could invest in. But there's a lot more summarization analysis that you do. There's things we can do, with FactSet, which is our kind of our way we look up information. It's a service. You can it's easier to search for things, so it can make you a little more productive. But I don't think so far, it has not had a big impact on how we invest. We have internal tools we're looking at in terms of trying to create our own little co-pilots where we can ingest all our information and hopefully all of our research and hopefully find insights. But I would say it's really early days for AI having a big impact on the investment process so far, at least for longer term investors.
And in terms of the sectors that are companies that it is impacting, I mean, like if you read some of the research, people are saying, the impact on productivity growth could be kind of like anywhere from 0.1% per annum to 1% per annum. So big variance in expectations there. What's your sense?
I think we could be surprised by the productivity benefits with AI. Again, it's so early. It's so fun. We have so many of these really good use cases like marketing, legal, programming. We have a lot of really good use cases that you can extrapolate that to a whole bunch of other sectors and say this is going to be amazing. But we just don't know. It's still it's funny. We have this giant industry with trillion-dollar companies, and it's still early. It's very, very early in the process around how much productivity we're going to get out of this. So it's really hard to make a definitive conclusion. I mean, I just go back to programming. We all told our children, hopefully my children ignored me, thankfully, go become a programmer. Go become a programmer because that's a huge upside, right? Huge, there's incredible demand for that. The problem is GitHub Copilot costs $19 a month. And with every time if you buy 4 subscriptions to GitHub Copilot, you can get rid of your 5th programmer. The programmer costs over $1,000 a year, right? It's just, the savings for that are off the charts, right? Documentation, translation, there's other things, documentation management, where it's just off the charts. The kind of benefits you, customer service, huge benefits. Going through a drive-through at Burger King, having a robot or an AI on their side instead of a person, huge benefits, right? There's a tendency to extrapolate to everything else, right? It's hard for investment management, right? It's not as easy investment management as as a drive-through at Burger King. I hope that
you would think so. Yeah. Just conscious of time, there's a couple of quick questions I wanted to get to. One was, obviously you're running the capital appreciation fund it's very much bond equity. I mean, if you were running a longer term portfolio, maybe an endowment, unconstrained, I mean, what would asset allocation and that look like, do you think, but on a kind of a 5 to 10 year view?
Oh, that's a really good point. Well, I would tell you the first thing is I wouldn't own any mortgages because the risk reward's not very good. I wouldn't own any international stocks. You get a lot of great companies and great diversification buying the U.S. market. So it'd be a combination of kind of GARPy U.S. stocks, high yield, leveraged loans, and I think the other area that I would be interested, I'd probably have, which I can't tell you, is probably you'd have some private equity there. Mid-market private equity is most of the large kind of mid private equity. Those would be the kind of the 4 assets: GARP stocks, high yield, leveraged loans, and kind of mid-market private equity.
Interesting. Good stuff. We always like to wrap up by getting just some advice for people maybe coming into the industry or people who want to get to be better investors. I mean, things that have been influential for you, in either books you've read or advice you've got, anything you would pass on?
One of the best books I read, we had a book club here that I actually started. A gentleman who Kahneman, Daniel Kahneman, who just passed away, I believe, recently. He wrote a book called Thinking Fast and Slow. And it's just about how we, as human beings, make decisions. How there's a tendency to make decisions based on not really good information. It's the idea of kind of thinking fast is how we traditionally make decisions. Maybe a little more emotion, not a lot of inputs. Thinking slow is actually thinking about all the different ways in which you can make a decision, all the different inputs you can use, and actually, having those inputs, having those kind of those samples, if you will, has helped you make a better decision. And again, as investors, I think Thinking Fast and Slow, it was probably the most important book as an investor I'd read in a long period of time. Even though it wasn't really written for investors, it's probably relevant to life and other things as well. But just how we make decisions and try and take the emotion out of that. I think that's a great book by again a great Nobel Prize winner actually.
Absolutely. Well, great stuff. Thanks very much for coming on, David. That's been great to get your insights and fascinating to hear about how you run your portfolio. So we very much appreciate it. Stay tuned. As ever, we'll be back with more content on Top Traders Unplugged. So we'll speak to you soon.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.